Hello, everybody. Luke Gromen, FFTT. Hope you are well. It has been an eventful couple of weeks since we last did one of these videos, to say the least. So let's jump right in, and we're going to keep it tight today. I'm heading down to Nashville, Tennessee tomorrow for the Bitcoin conference, so I hope to see some of you there. As always, thank you for the questions and thank you for tuning in. Let's jump right in. The first question is from David. Can you explain US dollar Dutch disease, specifically how it has contributed to the decline in U.S. manufacturing, and going forward, how decreasing treasuries as the global reserve asset can help revitalize U.S. manufacturing? So Dutch disease is another word for a resource curse, which the current vice president candidate has mentioned numerous times. He's used the words resource curse multiple times in the past year. It means that you as a nation produce one very needed commodity in very large size, cheaper than anybody else. And as you do so, you gain share of it, and the rest of your economy shrivels away and evolves to support that one industry. Dutch disease is in reference to Dutch gas production once upon a time, I think it was 70 years ago. But as the FT called it, the Financial Times called it, the United States is the Saudi Arabia of dollars. In the short run, this is a good thing. In the long run, it means the rest of the U.S. economy evolves so that we become very financialized, we become very deindustrialized, and that leads to high levels of wealth inequality, high levels of political instability, which suddenly is, how can we phrase it, very much a highly acute issue. And it means it's a national security risk. The United States, as we've seen in Ukraine, cannot go to war in any meaningful way with any meaningful near-peer power without factories that are based in China, without goods that are produced in China. That is simply unacceptable for a sovereign nation. And so that's the long-term downside of the resource curse, or of US dollar Dutch disease, of the dollar being, of the US being the Saudi Arabia of dollars. So you fix it by getting rid of treasuries as the primary reserve asset. You settle, instead of in treasuries, you settle deficits in a neutral reserve asset that floats in all currencies, either gold or Bitcoin. That's it. What you then end up doing is, obviously, given the size of the U.S. trade deficit and current account deficit, a lot of demand to settle. We're going to need a lot of gold or Bitcoin at current prices to settle those. That means the price of gold or Bitcoin, of the neutral reserve asset, has to go up a lot in dollar terms. Similarly, our creditors, China in particular, Europe to a lesser extent, Japan, they are going to have surpluses. And so basically what having a neutral reserve asset does is re-rate the SDR basket currencies around the neutral reserve asset based on balance of payment fundamentals. Countries with big trade deficits and big current account deficits will see their currencies fall a lot against gold or Bitcoin, against the neutral reserve asset. And those that are running big surpluses will see their currency strengthen against the neutral reserve asset. So basically, you will re-rate currencies based on balance of payments fundamentals, on which basis the United States dollar is the dirtiest dirty shirt by far, by virtue of the past 50 years dollar-centric system. So you would see the dollar fall sharply against the neutral reserve asset, gold or Bitcoin, but also against the yuan, against the euro, against the yen, and probably even against the pound, although the pound would be the second dirtiest dirty shirt of the SDR basket 5. So that's how you fix it. As the dollar then weakens, suddenly we get out of the IOU export business. We get rid of the Dutch disease, as the entire U.S. economy is geared to supporting financialization and exporting IOUs and Treasury IOUs specifically. And we actually get back to making a lot more stuff, thereby reducing wealth inequality, reducing political instability, and reducing the national security risk that is our inability to produce our own defense industrial base goods. All right, next question. From PD, what's the point of a central bank holding gold if the currency it issues can't be converted to gold? Great question. It's a very straightforward answer. Two parts. Number one, they hold it to restart the system after the system collapses, the current debt-based system. Number one, in case and eventually math ensures that it will on some level collapse on a real basis, they hold it to restart the system. Those aren't my words, although I agree with them. Those are the Dutch central bank's words 2 years ago. Secondly, for wartime trade. As it turns out, we have a historical example of this. If you have a major global conflict, your trading partners are not going to take your paper currency. For example, in World War II, before the United States was in the war, the UK was still one of the reserve currencies of the world. The US dollar was starting to take over by that point, but the pound had been the reserve currency of the world for over 200 years. Guess what the Americans wanted from the UK in return for lend-lease and for return for loans? They didn't want sterling, no sterling, gold or dollars. So wartime trade is another reason central banks hold gold. This then leads to a really interesting recognition if we carry this forward. There are fears of World War III, war with China. Okay, let's play that out. I hope they're totally wrong, but let's play that out. Given the example of the US and UK I just gave you in World War II, and by the way, we were friends, special relationship, all that stuff. Do you think if the United States goes to open conflict with Russia, let alone China, do you think China will accept paper dollars for Chinese goods? Or will they demand gold or yuan? And certainly if the United States, God forbid, were to go to war with China, do you think the Chinese would take dollars? Or do you think trade would shut off? Or the Chinese would take gold or Chinese yuan? And if that happened, which I think would be highly likely, in an open war with Russia, that the Chinese would very possibly only take gold or yuan, the dollar would fall, I think, quite sharply between the two, because we simply do not have the industrial base to go to war. We don't. Not against a near peer power, a nuclear armed power, which then takes us back to the point about the Dutch disease and why it's a threat to national security. So, third question. Luke, would you say that the stock market is currently pricey for long-term investors? In gold terms, yes. In Bitcoin terms, yes. In dollar terms, it depends. To consider the stock market expensive in dollar terms, in my opinion, one needs to ask oneself a question. Will the US government allow itself to be defunded by Fed rate hikes? In other words, Fed hikes rates and US government says, oh, our interest expense is so high. Cut the fence, cut entitlements. Well, we know that isn't going to happen because we've seen it already multiple times over the last 2.5 years. If the answer is yes, they will allow themselves to be defunded, then yeah, the stock market's probably pricey in dollars too. But if the answer is no, and we know the answer is no to that question, the US government's not going to let itself be defunded by Fed rate hikes, then no, stock market's not particularly expensive in dollar terms. It's up, but it's not particularly expensive in my view, because the risk-free asset off which stocks and every other asset is based is far more expensive, right? So if the risk-free asset in our capital asset pricing model, treasuries, the United States government has debt of 9 times revenues. They have OPEB liabilities, or off-balance sheet entitlement liabilities, of 20 to 30 times revenues, and they haven't turned a profit. The United States has not run a surplus in 24 years, 23 years. So if that's AA or AAA, which is like lipstick on a pig, then in dollar terms, no, stocks aren't particularly pricey. They're not cheap, but they're not particularly pricey. So I think it's important to have that context. The denominator matters that we're measuring things in. Okay, next question. From John, is there a major Wall Street asset class that you expect to not be backstopped by the Fed in a crisis? Is there a hard asset class you'd expect to not hold up through financial repression? I'm thinking anything, everything from metals, art, collectibles, land, commercial real estate. Um, Commercial real estate is, I think, valid. I think it depends on where it is, etc. However, I think is critical is that the Fed and U.S. policymakers have repeatedly backstopped the Treasury market. And again, the Treasury market is the asset off which everything else is priced. And so if U.S. policymakers are not going to allow the Treasury market to dysfunction up to and including Treasury auction failures and slashing government spending to make room for higher interest expense, which they've shown they're not going to do in either case, then it's the base layer is going to be backstopped, and that's all you need to know. Everything else should respond in price accordingly, which is to say higher over time in a financial repression scenario. And the final question from Andrew: what happens when our net international investment position trends back towards zero, currently around negative 80% of GDP? What would it take for that to happen? Under the current system, you would either need a Great Depression, a second Great Depression, which is sort of a really strong dollar that basically forces the entire global dollar-denominated borrowing, 13 trillion or so, plus the global euro-dollar system, 10 trillion, 20 trillion, 30 trillion, who knows. That would have to unwind, which is to say the world sells US dollar assets, 57 trillion gross, 22 trillion net that they own, to raise dollar liquidity. That could get it moving back towards zero. The other way is you would get some sort of very significant overnight US dollar devaluation, which devalues the global, basically dollar value of assets relative to GDP maybe, and changes trade flows. But it's really more the first case. So with that, I am going to finish up for today. Thank you again for your time. Hopefully I'll see some of you down in Nashville. Otherwise, everybody have a great rest of your week. We'll talk with you soon. As always, if you like these updates, check out FFTT Tree Rings, FFTT-LLC or FFTT-treerings.com, excuse me. 10 most interesting things, brief synopsis on what grabbed our attention about them, whether they're either confirming or changing a way we had previously been thinking about the world. So, as always, thanks for your time, everybody. Look forward to seeing you soon. Take care, everyone.